Earnings season just started, and as always, I like to analyze banks every quarter even though I don't own them at all. I like to do this because banks' earnings could give us a hint of how the economy is looking and what we should expect in the coming months. Hello everyone, welcome back to the channel. Today I will do a small overview on the economy. We'll analyze Wells Fargo and JPM earnings and compare both companies. If you're new to my channel, welcome, and please consider subscribing and smashing that like button since it really helps the channel out. Also, if you like to join to my Discord group chat, it's completely free and the link is down in the description below. Now, even though the economy has been improving in the US, non-farm payroll employment has been increasing nicely since March. Lockdowns are over in almost every state and we are kind of back to the new normal. As of March, we still have an unemployment rate of 6%, which obviously it has improved since March by a lot, all the way down from over 14%, but has not reached pre-pandemic numbers yet of below 4%. Obviously, banks were one of the most affected by unemployment after the people that got unemployed, obviously, because that made it very difficult for people to pay their loans or credit cards on time. And obviously we got scared because of what happened in 2008. But in my opinion, the Fed reacted really fast by lowering interest rates and giving tons of money in stimulus. The dark side about this is inflation. Obviously, for banks, it is not that good since it lets borrowers pay back their money that is worth less than when the loan was originated. But on the other hand, banks do benefit because if inflation increases, cost of living increases, which means that people will need to spend more money to live and would have less money to satisfy their obligations. This completely benefits lenders because people will need more time to pay off their debts, allowing the lender to collect interest for the longer period of time. Through my last bank video, we saw that inflation was actually dropping and it was at 1.4%, which seemed strange, and now 3 months later we can see that it is at all the way up to 2.6%, way higher than 2019, and that is why I like to do this video quarterly to keep track of the economy. Now let's talk about the banks. First of all, JPM. They reported a revenue of $33 billion for quarter one, which is a 9% growth quarter over quarter and 14.16% year over year. One of the most important things to look at right now in a bank income statement is the provision for credit losses, which mainly indicates what the bank is expecting to lose in credit cards and loans, and also indicates what might happen in the future with consumer spendings. In this case, JPM reduced their provision for credit losses by a lot to negative $4.1 billion, which means that this quarter it was a net benefit in comparison to last year, which was an expense. Since the provision for credit losses was now a benefit and not an expense, it helped boost banks' earnings since those funds were now released. It was an excellent improvement quarter over quarter and year over year. Finally, they reported a net income of $14.3 billion, which was a nice growth of almost 400% year over year. But as I said, this was possible because of the provision for credit losses. Or as they said, net income was $14.4 billion, up for $11.4 billion, predominantly driven by credit reserve releases of $5.2 billion compared to credit reserve bills of $6.8 billion in the prior year. This is actually excellent since it means that even though unemployment rates are still kind of high, they see the economy is back to the new normal. Now the consumer and business banking is down from 6.2 million to 5.6 million dollars, which is a 10% drop year over year. According to them, this was driven by the impact of deposit margin compression, largely offset by growth in deposit balance. Then the home lending business actually increased to $1.4 billion, while the car and auto dropped to $5.4 billion. In their balance sheet, they had total assets of $3.68 billion and total liabilities of $3.40 billion. Then Wells Fargo. We know that Wells Fargo has suffered even more since their scandal years ago, and that kept affecting them last year because of the Fed's cap on assets. Still, they reported a total revenue of $18 billion, which was a growth of 1.9% year over year. As you can see, they also had a nice provision for credit losses of negative $1.05 billion, which is also excellent because they also benefited from this in comparison to last year, and that helped boost banks' earnings since those funds were released now. They did report a net income of $4.7 billion, which was a huge growth from $653 million in 2020. Obviously, it seems excellent, but the provision for credit losses helped a lot. Their home lending increased year over year as well from $1.8 to $2.2 billion. Credit cards stayed almost flat and auto as well. Now, first quarter 2021 versus first quarter 2020. Revenue was flat as I mentioned. Consumer and small business banking was down 6%, primarily due to the impact of lower interest rates and lower deposit related fees due to higher average checking account balance and higher COVID-19 related fee waivers. Home lending was up 19% as higher retail mortgage originations and a higher gain on sale margin were partially offset by lower gains on loan portfolio. Then credit card was down 2%, primarily driven by lower balances and elevated payment rates, which this impressed me a lot, and I thought it was awesome because I would like to think that the pandemic helped people realize that it is not good, financially speaking, to have a balance in a credit card, and that savings are increasing as well since people are preferring to have cash on hand than debt on a credit card, which I think it is incredible because the interest rate for credit cards is really high. So something good has come out of the pandemic. JP Morgan is currently trading at $151.54 per share and has a market cap of $458 billion. Wells Fargo is trading at $41.99 per share with a market cap of $173.59 billion. A forward PE of 14.1 for JP Morgan and 14.64 for Wells Fargo, so they are very similar. Now, JP Morgan has a price to sales ratio of 4.04, while Wells Fargo 2.31, which means that, according to this, Wells Fargo is a way better deal and way better investment right now in comparison to JP Morgan. But then, JP Morgan had a revenue growth of 14%, while Wells Fargo was almost flat at 1.90%, but in net income, Wells Fargo grew 626%, while JP Morgan 399%. But remember that I mentioned that huge growth was due to the provisions for credit losses. Now, analysts are expecting both banks to have a decrease in revenue of 4 to 4.1% for the whole year 2021. As I said at the beginning, I like to do these videos to know how the economy is doing. I do have to say that I know that even though banks are huge, fintech companies like Square or PayPal are fighting back and disrupting the banking industry. Still, I think that both JP Morgan and Wells Fargo are a nice investment. Obviously, they were way better investment last year, but I think that in the long term, they will continue growing while you are able to collect dividends. I do not own any of the stocks anymore. I used to own Wells Fargo since it was the most undervalued bank at the moment, but have sold everything and started investing in other companies. With this bank's earnings, we started well-expected earnings seasons, and we are also able to see that the economy is certainly improving day by day, and we should continue improving until we are really back to the new normal. I will do another video next quarter, or maybe when Bank of America and Citigroup reports their earnings, because I'm filming this video on Thursday morning, so they haven't reported yet, but next quarter for sure, so we can have an update on the economy, unemployment, inflation, and everything else that could affect our investments. Now remember, I opened a second channel in Spanish, so if you or anyone that you know understands or speaks Spanish, please share the channel and you go and subscribe. It would mean the world to me. Also remember, I'm not a financial advisor, so you should do your due diligence before investing in any of these companies and not only take decisions because of what I said. Hope you enjoyed the video. Please smash that like button and subscribe since it really helps the channel out. Thank you and see you next time.